Hey guys, Andre here. I hope the end of your summer has been going well. And I just wanted to do a quick segment on a line of products for which I've been getting a lot of inquiries because homeowners are looking for a way to help tap their equity without touching their ultra low current interest rate first trust deed mortgage to pay and save on things like home improvement projects, student loan payments, high interest rate credit card debts, personal loan, even car loans and other expenses. The issue is that one of these mortgage products could have detrimental financial ramifications, and if you're going to jump into that product, you should be fully aware of how that product works, as this product is very different than any other mortgage product that's out there. So home equity or second trust deeds for the most part come in two flavors. We've got fixed rate second trust deeds, which kind of work exactly the same way as your first TDs do, so I'm not going to really dig into those. But the second one is a home equity line of credit, aka HELOC, also known as an ELOC, equity line of credit. They're synonymous. But we also offer things like reverse mortgage second trust deeds, which are great alternative for borrowers who are over 62 years old and don't want to have any payments. No tax return or bank statements, second trust deeds, those are great for self-employed borrowers because all the big box banks want tax returns, and we know that self-employed borrowers, pay good money to their accountants to keep their taxes low. So, and regardless of which product you're interested in, we can help you wade through your choices and make recommendations that best suit your financial needs. Now let's discuss the product, which is different than any other loan product and carries some concerning features that you need to be aware of if you're going to jump into that product. So equity lines of credit, or HELOCs, carry 5 concerning features or characteristics that could be dangerous. You got to be aware of them. 1, it is an adjustable rate mortgage, or ARM, which means that the rate the lender charges you on your outstanding balance can go up or it can go down. 2, the rate you are charged is based on an index, and all HELOCs use prime rate as the index. The issue is that prime rate index is extremely volatile. In other words, it can move very quickly. 3, unlike most other adjustable rate mortgage products, there are no monthly or even annual caps. These are features in all other adjustable rate mortgages to protect the borrower. So let me show you why this is dangerous by pulling up a 3-year chart of the prime rate index. Within 17 months, prime has risen from 3.25 to 8.5. That's an increase of over 160%. If you had a $100,000 balance, your payments have increased from $270 all the way to $708 in less than a year and a half. And that's just at the interest-only payment. And we'll talk a little bit more about that in a minute. 4, the lifetime rate cap on all HELOCs sits at 18%. Historically, prime has been over 18% 4 times. On that same example as before, your interest rate on a $100,000 balance could have potentially jumped from 3.25 all the way to 18% in 1 month. Now, the chances of that happening are very slim. However, per the terms or note of your HELOC, this could happen. So your monthly payment could have moved from $270 to $1,500 in 1 month. Number 5, finally, the interest payment or the interest-only payment on your HELOC is a double-edged sword. Your payments are substantially lower in the first 10 years because you're paying interest only, but the lender does eventually wish to be paid back, so at the end of the 10-year period, your loan changes from a interest-only payment to a fully amortized 20-year loan payment. So enough about the downsides of HELOCs. Let's discuss the benefits of the product. 1, flexibility. It is similar to a credit card, so you only draw what you need and you only have payments when you have a balance. 2, you can use the line over and over for the first 10 years through the draw period, so you draw, pay off, redraw, pay off, etc. Number 3, lower monthly interest-only payments in the first 10 years on your outstanding balance. So HELOCs are a great product for the borrowers who fit into the following categories. Borrowers who only need a small amount of cash, or they have the ability to pay off balances quickly from other assets they have. So if rates increase, they just pay off the balance. Number 3, because of substantial income, they can afford a large rate increase. And number 4, if the borrower needs to withdraw cash in increments and not a lump sum. Finally, there are some other items you should understand, like what is a floor rate, fees associated with a second trustee, appraisal requirement, and other alternative products. But you can call me to discuss those with any other questions you have. Like always, we're always here for a free consultation. Number should be in the original email or above. Please call me. I'd love to talk to you. All right, guys? Have a great afternoon and the rest of your summer. We'll talk soon. Bye-bye.